Wall Street's most respected analysts are warning that quantum computing stocks are sitting inside a genuine bubble, the kind of bubble history says always eventually burn teams. Meanwhile, the Pentagon just called quantum computing an existential threat to national security, signed executive orders accelerating quantum development, and set hard deadlines measured in years, not decades. Two of the most consequential conclusions. So which one is actually right? And what does it tell you when the market and the military disagree sharply about the same emerging technology? Let's start with the financial side of this story, because the numbers here are genuinely staggering and deserve careful, honest examination rather than dismissal in either direction. Quantum computing stocks have delivered some of the most extraordinary returns anywhere in the market over the past few years. As of mid-October 2025, trailing 12-month returns for pure-play quantum computing companies, including IonQ, Rigetti Computing, and D-Wave Quantum, reached as high as 6,217% for some of these names. Even looking at a full calendar year through mid-December 2025, shares of IonQ, Rigetti, D-Wave, and Quantum Computing Inc. climbed 68%, 333%, 568%, and 89% respectively. These are not modest, respectable gains. These are the kind of numbers that historically precede a very specific, very well-documented pattern in financial markets. Multiple Wall Street analysts have drawn a direct, explicit comparison between today's quantum computing stocks and the dot-com bubble of the late 1990s, and the comparison holds up uncomfortably well once you actually look at the underlying numbers. Before that bubble burst in March of 2000, companies leading that particular technological wave, names like Microsoft, Amazon, and Cisco Systems, peaked at price to sales ratios somewhere between 30 and 51. Financial analysts use that specific ratio, comparing a company's total market value to its actual annual revenue, as one of the most reliable historical indicators of unsustainable market enthusiasm, since it strips away accounting complexities and simply asks how much investors are paying for every dollar of sales a company actually generates right now. As of December 2025, Rigetti Computing traded at roughly 1,025 times sales. D-Wave Quantum traded at roughly 325 times sales. Even using more optimistic revenue projections, looking 2 full years ahead to 2027, analysts calculated that these companies' price-to-sales ratios would still sit well above that historical 30 to 50 range that has reliably signaled trouble for essentially every hyped technology trend over the past 3 decades, including genome decoding, nanotechnology, 3D printing, blockchain, and the metaverse, each of which followed a broadly similar boom and correction cycle. Here is a detail that genuinely deserves your attention if you are the kind of person who pays close attention to what corporate insiders actually do with their own money, as opposed to what they say publicly in press releases and investor calls. Insiders at IonQ, Rigetti, and D-Wave, meaning high-ranking executives, board members, and major shareholders who possess considerably more detailed, non-public information about their own companies than any outside investor could ever access, have been decisive, consistent net sellers of their own company shares over recent years. Reporting from mid-2026 specifically documented that this trio of companies had collectively generated more than $931 million, and what analysts characterized as a warning signal reverberating through Wall Street. Insiders cashing out at scale even as public enthusiasm for these exact same stocks continued climbing. The CEO and CFO of D-Wave, along with other board members, have been selling shares, and the CEO of Rigetti has followed a similar pattern. When the people running these companies, the ones with the deepest possible insight into their own actual technological progress and business fundamentals, are consistently taking money off the table, rather than continuing to hold or buy more shares. Themselves, that divergence between insider behavior and public market enthusiasm is exactly the kind of signal serious financial analysts pay close attention to. If you're finding this breakdown useful, go ahead and hit that subscribe button. There's also a genuinely important structural reason analysts point to when explaining why this specific bubble, if it is indeed a bubble, might be particularly vulnerable to a sharp correction. And it involves exactly how small the underlying market for quantum computing actually is today compared to the market capitalizations these companies currently command. Grand View Research has projected that the global quantum computing market will reach only around $4 billion in annual revenue by 2030. Compare that same time frame, meaning the AI market alone is projected to be roughly 425 times larger than the entire global quantum computing market, even 5 years from now. That comparison matters enormously for understanding investor expectations because it means quantum computing stocks are currently being priced, in many cases, as though the technology will achieve considerably faster, considerably larger scale commercial adoption than even the most optimistic current market projections actually support. Technology leaders themselves, people with genuine, deep expertise in exactly this field, have offered strikingly cautious public timelines that stand in sharp contrast to the enthusiasm currently priced into these stocks. NVIDIA CEO Jensen Huang stated that truly, useful quantum computers are probably around 2 decades away. Alphabet CEO Sundar Pichai separately stated that practically useful quantum computing applications remain at least 5 to 10 years away, specifically comparing quantum computing's current developmental stage to where artificial intelligence itself sat back in the 2010s, years before AI became the transformative, commercially dominant technology it represents today. Academic researchers have reached broadly similar conclusions through more formal analysis. Researchers at the University of California, Berkeley's Haas School of Business specifically indicated that practical, widespread applications of quantum computing in fields like drug discovery and financial risk analysis may not fully emerge until sometime around 2040, a genuinely enormous span of time compared to the kind of near-term commercial breakthrough that current quantum computing stock valuations appear to be pricing in as a much closer, much more imminent probability. It is worth pausing on exactly why this specific pattern, hyped technology, soaring valuations, eventual sharp correction, keeps repeating itself across entirely different technology sectors decade after decade. Because understanding that underlying mechanism helps explain why so many experienced financial analysts feel genuinely confident applying it to quantum computing specifically. Investors chasing a genuinely transformative technology consistently struggle to properly separate two distinct questions that feel similar but are actually quite different: whether a technology will eventually matter enormously, and whether any specific company pursuing that technology today will actually capture enough of that eventual value quickly enough to justify its current stock price. The internet itself turned out to be every bit as transformative as its most enthusiastic 1990s boosters predicted. Arguably even more so. That did not prevent the vast majority of individual .com companies from that era, including plenty of businesses built around genuinely sound underlying ideas, from losing the overwhelming majority of their value once the market's collective patience for unprofitable growth finally ran out. Being right about a technology's long-term importance and being right about a specific stock's current valuation are simply not the same claim, no matter how naturally investors tend to conflate the two when caught up in genuine technological excitement. There's also a specific, concrete technical reality worth understanding here, because it grounds this entire financial conversation in the actual current state of the hardware these companies have built, rather than leaving it purely as an abstract debate about valuations and investor sentiment. No company anywhere in the world has yet constructed a large-scale, fault-tolerant quantum computer, meaning a system genuinely capable of correcting its own errors in real time while possessing enough qubits, experts generally, I estimate somewhere between 10,000 and 1 million, to perform computations that are actually meaningfully useful for solving real-world problems businesses and governments genuinely care about. Rigetti's most advanced system currently contains only around 100 qubits, with plans to reach 1,000 qubits by the end of 2027. IonQ's most advanced system similarly sits around 100 qubits, with an ambitious target of 20,000 qubits by 2028. General-purpose gate-based architecture other companies pursue, and its most advanced system contains roughly 5. There is also a genuinely useful additional data point worth including here, involving how professional financial analysts themselves have been advising investors to think about this specific sector, given these two competing signals. Rather than simply advising investors to avoid quantum computing entirely, several Wall Street analysts covering this space have specifically suggested that exposure to the underlying technology might be considerably better achieved through the large, diversified technology companies pursuing quantum computing as one research bet among many, Alphabet, Microsoft, IBM, and Amazon among them, rather than through smaller pure-play companies whose entire market valuation depends almost exclusively on quantum computing succeeding commercially within a relatively narrow window. This distinction reflects a fairly standard, well-established principle in how professional investors approach genuinely uncertain, still maturing technology sectors more broadly, gaining exposure to a promising but unproven technology through financially stable, diversified companies that can comfortably absorb years of continued research investment without needing that specific division to become profitable on any particular timeline, rather than betting directly on smaller, more fragile companies whose Of dominant technology, giants routinely generate more free cash from their existing operations than they know what to do with. And they have historically shown little hesitation about aggressively investing in whatever the next transformative technology. Trend happens to be once it demonstrates genuine commercial promise. If quantum computing genuinely does mature into a commercially significant technology over the coming decade, exactly the kind of well-capitalized giants already running their own competing quantum research programs, rather than today's smaller, more specialized pure play companies, may end up capturing the majority of that eventual commercial value, precisely because they possess the patient capital, existing enterprise customer relationships, and broader technology infrastructure needed to actually commercialize quantum computing at meaningful scale once the underlying hardware finally becomes genuinely ready for widespread practical deployment. Now let's turn to the second half of this story, because it presents what looks, on the surface, like a genuinely striking contradiction to everything we have just walked through regarding market skepticism. While Wall Street analysts have been publishing detailed, numbers-driven arguments explaining exactly why quantum computing stocks look dangerously overvalued, the United States military has been moving in almost exactly the opposite direction, treating quantum computing with an urgency typically reserved for genuinely existential national security threats. Of a sufficiently powerful quantum computer as an existential threat to United States national security and to America's global military dominance. That same week, the White House signed 2 separate executive orders explicitly aimed at accelerating quantum technology development. One focused on defensive cryptography, directing federal agencies to speed their transition toward quantum-resistant encryption standards, and a second, more offensive-minded order directing the Pentagon to field entirely new categories of quantum sensors to operational military units within a specific, tight timeline measured in months rather than years. The Pentagon set hard compliance deadlines, requiring military systems to support post-quantum cryptography or be phased out entirely by the end of 2030, with mandatory usage required across the department by the end of 2031. This is not a government agency casually monitoring an interesting emerging technology from a comfortable distance. This is an institution moving with genuine, deliberate urgency, committing real budget, real personnel, and firm, specific deadlines to a technology that, according to the very same industry analysts warning investors away from quantum computing stocks, may not achieve widespread, genuinely useful commercial application for another decade or more. So how do we reconcile these two seemingly contradictory pictures? One suggesting quantum computing is dangerously overhyped and due for a painful correction, the other suggesting the technology represents a genuinely urgent, civilization-scale strategic priority deserving immediate, well-funded institutional action? The honest answer requires understanding that Wall Street and the Pentagon are actually evaluating 2 genuinely different questions, using 2 genuinely different time frames and 2 genuinely different risk calculations, even though both institutions are technically looking at the same underlying technology. Stock market valuations fundamentally depend on near-term commercial viability, meaning investors buying shares today are implicitly betting that these specific companies will generate substantial, rapidly growing revenue within a time frame short enough to justify current share prices, typically somewhere in the range of the next 2 to 5 years for most growth stock valuations to make reasonable mathematical sense. Military strategic planning operates on a completely different calculus entirely, one where the actual probability of a threat materializing in any given year matters considerably less than the catastrophic, potentially irreversible cost of being caught completely unprepared whenever that threat eventually does arrive, even if that arrival sits a full decade or more in the future. If you're finding this breakdown useful, go ahead and hit that subscribe button, because we cover stories exactly like this every single week, connecting the dots most channels leave scattered. It is also worth understanding that the Pentagon is far from acting alone on this front, and that broader international context helps explain why American military planners feel particular pressure to move with genuine urgency rather than waiting for commercial market signals to clarify themselves further. Allied nations, including the United Kingdom, Australia, Canada, and Japan, are pursuing broadly similar transitions toward quantum-resistant cryptography on their own overlapping timelines, and defense officials across these partner nations have increasingly emphasized the need for close coordination, since a shared cryptographic standard among allied militaries only provides genuine protection if every partner nation actually migrates on a roughly compatible schedule. A single lagging ally could, in theory, become the specific weak point an adversary targets first, regardless of how far ahead any other individual nation's own systems have already progressed. This kind of coordinated multinational strategic planning operates according to an entirely different logic than quarterly stock market sentiment, one where falling behind allied nations on a genuinely consequential emerging technology carries its own distinct category of strategic risk, separate entirely from whatever near-term commercial viability any specific publicly traded quantum computing company happens to be demonstrating at any given moment. This distinction matters enormously, and it is worth walking through concretely using the Pentagon's own specific reasoning, because it reveals why an institution can simultaneously agree with Wall Street's underlying timeline estimates while still acting with genuine, well-funded urgency today. The National Security Agency has stated as recently as this year that a cryptographically relevant quantum computer, meaning one could plausibly emerge sometime between 2030 and 2035. A timeline that, notably, sits reasonably close to the same decade plus The specific mechanism driving Pentagon urgency has a name: harvest now, decrypt later, and understanding it clarifies exactly why waiting for commercial proof of concept, the exact thing stock market investors are implicitly demanding before quantum computing stocks would deserve their current valuations, would represent a catastrophic strategic mistake from a military planning perspective. Adversaries do not need a working, cryptographically threatening quantum computer today to begin benefiting from this specific strategy. They simply need to intercept and store encrypted military communications right now, while completely unreadable, and wait patiently for quantum computing technology to eventually mature. Pulling substantial volumes of encrypted data from government agencies and major corporations, storing it indefinitely, betting specifically that quantum computing will eventually mature enough to unlock what they have already collected, exactly the kind of patient long-horizon threat that a purely technologically sprawling and as deeply layered with decades-old legacy infrastructure as the United States military away from today's encryption standards is not something that happens quickly, even once genuine political will and adequate funding both exist. That multi-year migration timeline, not any disagreement about when quantum computers will actually become dangerous, is precisely why the Pentagon felt compelled to meaningful, non-trivial chance that a serious storm might hit your specific region sometime in the next 5 to 10 years, though nobody can say with any real confidence exactly when. An individual investor deciding whether to buy stock in an umbrella company today needs that storm to arrive soon enough. Infrastructure today, regardless of the storm's exact arrival timing, precisely because infrastructure hardening takes years to complete properly, and the cost of being Pentagon follows almost exactly the same underlying logic, just applied to cryptography and computing infrastructure instead of literal storm preparedness. Pure play quantum computing companies genuinely do face serious risk of a sharp stock price correction. The Pentagon's own fiscal year 2026 research, development, testing, and evaluation budget topped $179 billion, a significant increase over the previous year, with quantum contingent on any single publicly traded quantum computing company like IonQ, Rigetti, or D-Wave succeeding commercially in the way current stock valuations would field, even during a period when public market enthusiasm for individual quantum computing stocks cools considerably, precisely because government planning horizons and government risk tolerance operate according to entirely different rules than quarterly earnings reports and short-term shareholder return expectations. It is also worth acknowledging honestly that these two seemingly contradictory forces, market skepticism and military urgency, are not entirely disconnected from each other, and understanding where they genuinely do intersect adds important nuance to this whole picture. Some of the very same established technology giants driving genuine, credible quantum computing progress, specifically companies like Google, IBM, and Microsoft, are simultaneously the companies whose broader financial stability and diversified revenue streams make Wall Street analysts considerably less worried about a painful correction in their stock prices specifically, compared to smaller, pure-play quantum computing companies whose entire business model depends almost exclusively on quantum computing, eventually becoming commercially viable within a relatively short time frame. Alphabet's Willow Quantum, 13,000 times faster than the best available classical supercomputer estimate. Microsoft unveiled its own Majorana quantum processor architecture around the same general period. These are precisely the kind of large, diversified, financially stable companies capable of funding genuinely patient, multi-year quantum research programs without needing that specific research division to generate substantial standalone profit within just the next 2 or 3 years, exactly the kind of pressure currently squeezing smaller pure play quantum computing stocks toward valuations analysts increasingly describe as unsustainable. play companies whose entire market valuation depends almost exclusively on quantum computing. Succeeding commercially within a relatively narrow window matters enormously for understanding exactly which parts of this broader quantum computing story genuinely deserve skepticism, and which parts genuinely deserve serious, sustained institutional attention. The Pentagon's own quantum strategy, tellingly, works with a genuinely diverse mix of partners, spanning both large, financially stable technology companies and smaller, specialized quantum-focused firms, but its core strategic urgency around cryptography specifically stems from the underlying mathematical threat quantum computing eventually poses to encryption, a threat that exists regardless of which specific company or companies eventually succeed in building the actual hardware capable of realizing it. So where does this leave someone trying to make sense of these two seemingly contradictory signals? One from Wall Street, one from the Pentagon, both looking at the exact same underlying technology? The honest, balanced answer is that both signals are likely correctly identifying real, genuine phenomena, just measuring fundamentally different things, using fundamentally different timeframes and fundamentally different risk tolerances. Wall Street's warnings about, well supported by the underlying numbers, the historical pattern of previous hyped technology bubbles, and the well-documented, consistent insider-selling behavior among executives who possess the deepest possible insight into their own company's actual prospects. At the same time, the Pentagon's underlying strategic logic that a technology capable of eventually threatening encrypted communications deserves proactive, well-funded preparation today, regardless of exactly when it becomes commercially mature, holds up as genuinely sound institutional risk management, entirely independent of whether any specific publicly traded quantum computing stock happens to be fairly priced at this exact moment. Competing narratives, market skepticism, and institutional urgency tend to eventually resolve themselves over a long enough time frame. Government and military investment in emerging technologies has historically preceded, sometimes by many years, the eventual point where those same technologies became genuinely, broadly commercially viable for private industry. The commercial internet most people actually use today ever took shape. GPS technology, now embedded invisibly inside essentially every smartphone on the planet, began as a purely military navigation system developed and funded entirely by the Pentagon long before any civilian company found a way to essential groundwork for a commercially transformative technology that eventually arrives, just not necessarily on a timeline that organizations, public or private, ultimately prove best positioned to commercialize the technology once it genuinely matures. It is important to be clear here that none of this constitutes financial advice, and this video should not be treated as a recommendation to buy, sell, or avoid any specific stock. I'm not a financial advisor, and decisions about individual investments depend heavily on your own personal financial circumstances, risk tolerance, and investment timeline, factors only you and a qualified financial professional can properly evaluate together. What this story genuinely illustrates, regardless of where any individual investor ultimately lands on quantum computing, important, genuinely worth serious institutional investment and preparation, and also genuinely overvalued in specific publicly traded companies whose stock prices have run considerably further ahead of realistic near-term commercial prospects than the underlying fundamentals can currently. The next time you see a headline proclaiming that quantum computing stocks are either about to make early investors fabulously for language as strong as existential threat in an official government policy document, remains genuinely well supported by real, credible scientific and military analysis. Whether any specific publicly traded company currently commanding hundreds of times its actual annual revenue and market valuation deserves that particular price tag. Today is a considerably narrower, considerably more uncertain question, one that history, and specifically the well-documented pattern of previous technology bubbles rising and eventually correcting, suggests investors should approach with genuine caution rather than uncritical enthusiasm. If you want to keep following both halves of this genuinely fascinating story as they continue developing, the market's verdict on individual quantum computing stocks and the military's continued strategic investment in the underlying technology itself, make sure Pentagon spending and the ongoing race toward genuinely useful quantum hardware, this particular intersection of Wall Street and national security, is only going to keep generating stories worth understanding clearly.